When it comes to investing, there are many options to choose from. But if you're looking for a safe place to store your money, then you may be wondering, where is your money safer? In the bank or invested in an index fund? This video will explore the pros and cons of both bank accounts and index funds so that you can make an informed decision about where to invest your money. Safety. One of the primary concerns for any investor is the safety of their money. Bank accounts are often seen as the most secure option for storing funds, with the backing of the Federal Deposit Insurance Corporation guaranteeing up to $250,000 per depositor per insured bank. This means that even if the bank were to fail, your money would be protected. Index funds, on the other hand, are not insured by the government. However, they offer a degree of safety through diversification, as they typically invest in a wide range of stocks or bonds. This can help mitigate the risk of losing money on a single investment, as opposed to putting all of your money into one company's stock. It's worth noting that the level of risk and safety involved with each investment option can vary depending on the specific bank or index fund you choose. Before making any investment decisions, it's important to do your research and consult with a financial advisor to ensure that your money is as safe as possible. Liquidity. When it comes to liquidity, bank accounts take the win hands down. Your money is easily accessible in a bank account, and you can withdraw it at any time without penalty. This is especially important for emergency funds or unexpected expenses that may require quick access to cash. On the other hand, investing in index funds requires a bit more planning and forethought when it comes to liquidity. While you can sell your shares and access your money relatively quickly, there may be penalties or fees for early withdrawals or selling at the wrong time. Additionally, it's important to consider market conditions and fluctuations that may impact the value of your investment if you need to sell during a downturn. Overall, if liquidity is a top priority, keeping your money in a bank account may be the safer option. However, if you're willing to take on a bit more risk and have a longer investment timeline, index funds may offer greater potential for growth and returns in the long run. Ultimately, the decision between the two options depends on your personal financial goals and risk tolerance. Yield. When it comes to yield, investing in index funds can offer a potentially higher return than keeping your money in a bank account. The average interest rate for savings accounts is currently between 4 and 5%, while the average return for a diversified index fund over the long term is closer to 7 to 8%. Of course, there is no guarantee that an index fund will always outperform a bank account. The stock market is known for its volatility, and past performance is not a reliable indicator of future results. However, over a long enough period, historical data suggests that index funds have the potential to provide a better yield than a savings account. It's also important to keep in mind that higher yields often come with greater risk. While an index fund may have the potential for higher returns, it also carries the risk of losing value if the market takes a downturn. In contrast, bank accounts are generally considered low-risk investments because the Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. Ultimately, the decision of where to put your money depends on your financial goals and risk tolerance. If you're looking to earn a higher yield and are comfortable taking on some risk, index funds may be a good option for you. If you prioritize safety and liquidity over higher returns, keeping your money in a bank account may be a better fit. Taxes. One factor to consider when deciding where to keep your money is the tax implications of your choice. Banks offer FDIC insurance on deposits up to $250,000, which means your money is safe from loss due to bank failure. However, interest earned on bank accounts is subject to federal and state income taxes. Index funds, on the other hand, typically offer lower tax rates on earnings. This is because index funds are considered a type of investment and are subject to different tax rules than bank accounts. Capital gains tax on investments held for more than 1 year is typically lower than income tax rates, which may make investing in index funds more appealing to those who want to minimize their tax liability. It's worth noting, however, that investing in index funds can also result in capital gains taxes when shares are sold at profit. It's important to consult with a tax professional to determine the tax implications of investing in index funds versus keeping money in a bank account. Ultimately, deciding where to keep your money should depend on your financial goals and risk tolerance. Both options have their pros and cons, and it's up to you to decide which option makes the most sense for your financial situation. Diversification. When it comes to investing, diversification is an important factor to consider. Diversification means spreading out your investments across multiple assets or markets to reduce the risk of losing your money. By investing in a variety of stocks or bonds, you can minimize your exposure to market volatility and potentially improve your returns. When you deposit your money into a bank account, you are essentially putting all of your eggs in one basket. Your funds are protected up to a certain amount by the FDIC, but the interest rates are typically low and do not keep pace with inflation. Therefore, you are not diversified, and your money may not be working as hard for you as it could be. On the other hand, index funds are an excellent way to diversify your investments. Index funds are made up of a basket of securities that track a particular market index, such as the S&P 500 or the Dow Jones Industrial Average. This means that your investment is spread out over a variety of different companies rather than just one. If one company performs poorly, it is offset by the others in the index fund. Additionally, index funds provide investors with the ability to invest in a broad range of asset classes, including domestic and international stocks, bonds, and real estate. This means that you can further diversify your portfolio across multiple sectors and markets, reducing your overall risk. Overall, when it comes to diversification, index funds offer investors a significant advantage over bank accounts. By diversifying your investments, you can potentially improve your returns and protect yourself from market volatility. If you are looking to invest for the long term, diversifying your portfolio with index funds may be a wise choice. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.